This is a demonstration of problem 2116B operating lease. Low Falls Corporation entered into a lease agreement on January 1st, 2020 to provide Amazon Fleet Company with a piece of machinery. The terms of the lease agreement were as follows. 1. The lease is to be for 3 years with rental payments of $9,249 to be made at the beginning of each year. 2. The machinery has a fair value of $61,000, a book value of $47,000, and an economic life of 8 years. 3. At the end of the lease term, both parties expect the machinery to have a residual value of $40,000, none of which is guaranteed. 4. The lease does not transfer ownership at the end of the lease term, does not have a bargain purchase option, and the asset is not of a specialized nature. The implicit rate is 5%, which is known by Amazon Fleet, and the collectability of the lease payments is probable. In the instructions, it states in Part A to evaluate the criteria for classification of the lease and describe the nature of the lease. So this lease will be classified as an operating lease for both the lessee and the lessor. The lease does not transfer ownership at the end of the lease term, does not have a bargain purchase option, and the asset is not specialized. In addition, neither the 75% test nor the 90% test are met. So for the 75% test, we look at the lease term, which was 3 years. We divide that by the economic life of the equipment, which was 8, and we get 37.5%. So that is not more than 75% of the economic life. So it did not meet that test. To determine the 90% test, we first look at the present value of the rental payments, which the problem gave us as $9,249, and we multiply that by a factor based on 3 years and an interest rate of 5% for an annuity due, and that factor is 2.85941. So we get the present value of the 3 rental payments, and we compare that to the fair value of the asset, which is $61,000, and we see that it is only 43%. The present value is only 43% of the fair value. So we see that the 90% test was not met. And of course, we don't include the present value of the residual value because it is unguaranteed. The B portion states prepare the amortization schedules Amazon Fleet will use over the lease term. So that is what we're going to do first. The first amortization schedule is going to be the lease amortization schedule for the lease liability. We know that we will record the lease liability at the present value of the rental payments, or $26,447. The first lease payment that will be made on January 1st, 2020 of $9,249 will all be credited to the debited to the lease liability, because at that point there would be no interest due. Then we will complete the amortization schedule for the remaining 2 payments of $9,249, because we'll be using those to help us construct the lease expense schedule. So we know when we have an operating lease, we're only going to be recording one amount of lease expense, and that is going to be equal to the lease payment. So we have to divide that between the interest that we will credit to the lease liability and the amount of the amortization of the right of use asset. So at the beginning of the lease term, the right of use asset will have a value of $26,447. At the end of the year, at 2020, we will record our first lease payment of lease expense of $9,249. $860 of that will go to our lease liability, and we will amortize the right of use asset for the difference, $8,389. So that will keep that lease expense amount at a straight line basis. We will do the same thing the next year. We will record lease expense of $9,249 $249. $440 of that will go to the lease liability, and the remaining amount, $8,809, would go to the amortization of the right of use asset. And then the last year, the last payment, $9,249, will all go to the amortization of the right of use asset. So now we have the information to continue with the problem, and in C it states prepare the 2020 entries for Amazon Fleet Company, and in D prepare the 2020 entries for Low Falls, the lessor. So we start out with the lessee, Amazon Fleet Company, and we record at the inception of the lease we would debit our right of use asset for $26,447 and credit the lease liability for the same amount. We would also make our first payment on that date for $9,249, which would be debited to the lease liability, and we would credit cash for the same amount. At the end of the year, we would record our first lease expense per the lease expense schedule that we made. So our lease expense again will be $9,249. We would credit the lease liability for the $860 for the interest, and we will credit the right of use asset for the difference for the amortization of $8,389. Next, we're going to record the entries for the lessor for Low Falls. Low Falls would receive on January 1st, 2020, the first rental payment or lease payment of $9,249, and they would debit cash. They would credit unearned lease revenue for the same amount, because at that point they have not earned any of the lease revenue on the inception of the lease. At the end of the year, at December 31st, they would debit unearned lease revenue for the same amount, and they would credit lease revenue because it would then be earned. They would also need to depreciate the equipment because it's still on their books. So they would determine the depreciation by taking the book value, $47,000, and dividing it by the economic life of 8 years, and that would be equal to $5,875. So they would debit depreciation expense for $5,875 and credit accumulated depreciation leased equipment for the same amount. In the last part of the problem, it states, suppose the lease were only for 1 year instead of 3 years, with just one lease payment at the beginning of the lease term. Prepare any journal entries Amazon Fleet would need, assuming it elects to use the short-term lease option. So we know that if a lease is a year or less, they don't have to capitalize or record a right of use asset. So Amazon would only debit lease expense for $9,249 and credit cash for the same amount. And that is the conclusion of the demonstration for problem 2116B.